want you to try something. Picture a standard news report about the economy in Africa. Just, close your eyes and think about the headlines you've seen over the last, 20 or 30 years. What comes to mind?
It's usually pretty bleak. Or, if it's positive, it's a very specific kind of positive. It's about foreign aid.
Foreign aid, right?
Or debt relief packages. Or, the World Bank approving a new loan.
Exactly. It's this very persistent narrative that the solution for economic growth in Africa has to be imported. It just assumes that the financial rails, the actual plumbing of the system, have to be built by Western institutions, and African nations they just have to ride on them and pay the fare, of course.
It's a narrative that's really centered on dependency.
Yeah.
It basically says, we'll help you catch up to us, but on our terms.
But today, we are going to shred that narrative. Because looking at the stack of research we have here, we've got reports from Yellow Card, analysis from Vanguard, the African Leadership magazine, some really dense academic work. That old story is just dead wrong. The shift we're seeing isn't driven by a UN resolution or an IMF package. It's being driven by digital code.
This is what we're starting to call economic sovereignty.
That is the buzzword for today. We're doing a deep dive into how cryptocurrency, and specifically something called a stablecoin, is allowing African nations and individuals to just bypass the traditional global banking system.
You can't.
Completely. They're not asking for a seat at the table anymore.
They're building their own table. And to really get this, you have to understand the concept of leapfrogging. It's a term economists just love.
Give us the classic example.
Think about telephones. In the US and Europe, we spent, 100 years stringing copper wires across every city and town for landlines. When Africa's turn came, they looked at the cost of all that copper, the difficult geography, and they just said, you know what, no thanks.
Right, they just skipped it.
They skipped it entirely and went straight to mobile towers. They jumped over that whole intermediate step to the modern solution. And that is exactly what's happening right now with money. They were skipping the clunky, expensive, slow legacy banking systems and moving straight to blockchain finance.
And the goal isn't just convenience, right?
Not at all. It's about taking control. It's about sovereignty.
Now, I have to play the skeptic here for a second, because I know when a lot of our listeners hear crypto in Africa, their minds immediately go to, some guy in a basement buying Dogecoin hoping it goes to the moon so he can buy a Lamborghini. Is that what we're talking about?
No, not at all. That is probably the biggest misconception. We are not talking about speculation here. We're not talking about gambling. The consensus across all of these reports, especially the data from Yellow Card, is that the crypto conversation in Africa has moved on from hype to boring essential utility.
Boring is good. Boring means it actually works.
Boring is where the real revolution happens. It's about paying your bills. It's about paying your suppliers. It's plumbing.
Okay, so let's get into the mechanics of this plumbing. Because to understand why this new sovereign system is taking off, we have to understand why the old one is so hated. The Vanguard analysis uses a very specific word, friction.
Which is a very polite word for nightmare.
Yeah.
So let's paint a picture. Imagine you're a Nigerian entrepreneur. She runs a textile business in Lagos, and she needs to pay a supplier in China, or maybe import machinery from the UK.
Okay.
In the traditional world, she walks into her local bank, and this is where the trouble starts. She fills out a form for a wire transfer using SWIFT. Now, most people think SWIFT is like sending an email. You hit send, the money arrives. It does not work like that.
Wait, unpack that for me. SWIFT doesn't actually move the money.
No. SWIFT just sends a message. The message says, please move this money. But here's the catch. Her bank in Lagos doesn't have a direct relationship with the supplier's bank in London or Shanghai. They're strangers.
So they need an introduction.
They need a whole chain of introductions. We call them correspondent banks. It's like a bucket brigade. Bank A passes the message to Bank B, who passes it to Bank C, who finally gets it to Bank D.
And I'm guessing every hand that touches the bucket takes a little sip.
Exactly. Every single bank in that chain takes a fee. And it takes time. We're talking 3 to 5 days for that money to actually settle. And the fees, they can eat up anywhere from 7 to 10% of the transaction's value.
Hold on, 10%. So if I'm that entrepreneur and I'm on thin margins, which, most small businesses are losing 10% just to pay a bill, is devastating.
It's a massive tax on growth. It makes African businesses uncompetitive before they've even started. And it's even worse for individuals. If you look at remittances, people working abroad sending money home, sub-Saharan Africa faces the highest fees in the world.
What are the numbers on that?
The data shows it costs, on average, 7.9% just to send $200.
Wow, so I send $200 to my mom for groceries, and the system just eats 16 bucks of it for moving bits on a server.
Yes. And that system creates dependency, and it leaves a huge gap. We have data showing nearly 300 million adults in sub-Saharan Africa are unbanked. The old infrastructure just failed to reach them.
So the old system is broken, it's expensive, it's slow, and it excludes people. So enter the hero of our story, the stablecoin. For the listener who has zero crypto knowledge, what is a stablecoin?
The simple definition is it's a cryptocurrency that's pegged to a stable asset. Usually that's the US dollar. So 1 unit of a stablecoin, like, say, USDC or USDT, is always worth $1.
So it's not swinging wildly up and down like Bitcoin.
No. Bitcoin is volatile. It can drop 10% while you're having lunch. Stablecoins are designed to be boring. They're just digital dollars that ride on blockchain rails.
And according to the Yellow Card report, this is where the usage is just exploding. I was looking at the stats. Stablecoins made up 43% of total crypto transaction volume in sub-Saharan Africa in 2024.
That's nearly half the market. It just proves that people aren't looking for a lottery ticket. They're looking for a better dollar.
And Nigeria is an absolute heavyweight here. We're talking $59 billion in transaction volume in 2024 alone.
Just to put that number in perspective, that is larger than the entire GDP of many countries. It's massive. And then you look at South Africa, stablecoin use grew 50% month over month. It actually displaced Bitcoin as the most popular crypto.
So let's go back to our Nigerian entrepreneur. How does her life change with this tool?
It changes completely. Instead of going to the bank, she opens a wallet on her phone. She buys stablecoins with her local currency, the Naira, and she sends them directly to her supplier.
No bucket brigade.
No bucket brigade, no middleman. The settlement happens in minutes, not days, and the cost is usually just pennies, no matter how much she's sending.
But there's another layer here that the sources really highlighted. In countries like Ghana, Zimbabwe, or Nigeria, the local currency can face really high inflation.
Right. So if you keep your savings in Naira, and the Naira loses 20% of its value against the dollar in a year, you just lost 20% of your wealth.
So holding stablecoins is a way to just opt out of that local inflation.
It's a hedge. It lets businesses and individuals preserve their purchasing power. It's kind of like having an offshore U.S. bank account, but you don't need a passport or a huge minimum deposit. You just need a smartphone.
And the cost savings are just dramatic. I read about this pilot program in Kenya run by Mercy Corps Ventures. They use stablecoins to pay gig workers.
Yeah, these are people who usually get absolutely crushed by PayPal fees or wire transfer minimums.
The report said they slashed the remittance fees from around 29% down to just 2%.
I mean, think about that. From 29 to 2. That's not just an efficiency upgrade. That's money for food. That's money for school fees. In Kenya overall, stablecoin transactions are about 85% cheaper than the old way.
It's a total paradigm shift.
Yeah.
Which brings us back to leapfrogging. We skipped landlines, now we're skipping banks. But there's another layer to this I find fascinating. The Vanguard source talks about programmable money. Sounds a bit sci-fi. What does that mean?
This is where we go from better payments to better trade. The source quotes a smart contract engineer, Vincent Adesanmi, and he explains smart contracts. Think of it as a digital agreement that enforces itself.
Like a vending machine.
That is the perfect analogy. You don't need to trust a cashier that if you put money in, you'll get a soda out. The machine is programmed to do it. Money in, product out.
Okay, so how do you apply a vending machine to international trade?
Take that supplier payment again. In the old world, if you don't trust the supplier in China, you have to use something called a letter of credit from a bank. It's basically a guarantee.
Which is a huge pain to get, right?
It's expensive, it involves lawyers, paperwork, and if you're a small business, the bank might just say no. With programmable money, you can use a trustless escrow. You put the stablecoins into a digital smart contract. That contract is connected to shipping data, and it's programmed to release the funds to the supplier only when digital tracking confirms the goods have arrived at the port in Lagos.
So the code itself becomes the middleman.
Yes. It replaces the bank, the lawyer, the escrow agent. It creates a trustless environment where you don't have to trust the other person. You both just have to trust the code.
And this ties directly back to sovereignty. Because if you can do that, you don't need the Western banking system to validate your trade.
The Vanguard article argues this so powerfully. It's about shifting from reliance to independence. Foreign aid can be political. It can be turned off if the winds change in Washington or Brussels. A decentralized infrastructure. It's consistent. It lets you build a business without asking for permission from a bank halfway across the world.
And who's driving this? It's not the guys in suits, is it?
No, it's the youth. Africa has the youngest population in the world. 60% are under 25. The African Leadership magazine highlighted that Telegram-based crypto communities, basically chat groups, have grown by 189% since early 2023. This is a grassroots, bottom-up revolution.
However, history tells us that when you have a bottom-up revolution, the top eventually notices, and they usually want to get involved.
Or take control.
Which brings us to the government response. States aren't just watching this happen, they're trying to build their own versions. This is the big battle. Private crypto versus CBDCs, central bank digital currencies.
Right. This is the government saying, hey, we see you like this digital money thing. Here's our digital money. Please use this instead.
And Africa has actually been a pioneer here, hasn't it?
Surprisingly, yes. Nigeria launched the Naira back in October 2021. It was the first CBDC in Africa. Ghana is piloting the ECD.
Okay.
South Africa is looking at wholesale models for banks.
But looking at the numbers in the report, the Naira hasn't exactly been a smash hit.
That is putting it very mildly. It was a massive flop. By October 2023, less than 0.5% of Nigerians had actually adopted it.
Less than 0.5%. That's basically a rounding error. Why did everyone reject it?
It really comes down to one word: trust. The Scholarship Archive and the African Leadership magazine both talk about this idea of tech without trust. In countries with a history of inflation or currency devaluation or just general mismanagement, people are very, very skeptical of money that is fully programmable by the state.
Because a CBDC is the opposite of privacy.
Exactly. If I use a private stablecoin, it's relatively private. If I use a CBDC, the government knows exactly what I'm buying, where I'm sending it, and this is the crucial part. They control it. They could devalue it tomorrow with a keystroke.
So people saw it less as inclusion and more as surveillance.
Precisely. So they stuck with private fintech apps like OPay or PalmPay, or they just went straight to stablecoins.
So the governments are in a bind. They can't beat the tech, and their own version isn't catching on. So how are they reacting now?
It's a real mix. Nigeria has moved from hostility. I mean, they literally tried to ban banks from dealing with crypto a few years ago to regulation. They're now setting up frameworks, figuring out how to tax it. They realize they can't stop the tide.
If you can't ban it, tax it.
The classic government playbook. South Africa is being more structured. They've mandated licenses for crypto firms. Over 60 have applied. They're treating it like a formal financial asset.
And then there's Ethiopia. This was the biggest surprise for me in the research.
A huge surprise. Ethiopia made this fascinating strategic pivot. They're not just regulating, they are producing. They've signed deals to allow high-performance computing and data mining for Bitcoin.
Why? Why would a government get into Bitcoin mining?
Energy. Ethiopia has massive hydroelectric resources from the Grand Ethiopian Renaissance Dam, but sometimes they generate more power than the grid can use, so instead of just wasting that energy, they're selling it to Bitcoin miners.
So they're literally turning surplus electricity into digital currency.
Correct. They are now contributing something like 2.25% of the global Bitcoin hash rate. It positions them as a producer in the digital economy, not just a consumer. It's a brilliant way to monetize a natural resource.
I want to zoom out a bit. We've talked about the mechanics, the politics, but there's a deeper theoretical framework here that one of our sources, the Scholarship Archive, gets into, and that's Afrofuturism.
Yes. And I know when people hear that word, they think of sci-fi, like Black Panther. But in this context, it's a serious economic lens. It views crypto not just as a tool, but as a way to correct historical exclusions.
Because the traditional financial system, the one built during the colonial era, was never really built for these populations.
It was often built to exclude them, or at least to extract value from them. So the Afrofuturist argument is that you can't just tinker with the margins of that old system and expect equality. You can't just fix the World Bank. You need wholesale systems change. You need to build something new.
And crypto offers that because it's permissionless. The code doesn't care about your credit history or where you live.
It only cares if you have a connection.
And that's the catch, isn't it?
Yeah.
We have to be balanced here. Tech isn't a magic wand. There are some huge blind spots in this sovereignty story.
Massive ones. You can't have digital sovereignty without electricity and data. The African Leadership magazine points out that only 49% of sub-Saharan Africa even has mobile internet. Only 39% own smartphones.
So if you don't have a smartphone, you're just as locked out of this revolution as you were from the old banking one.
Exactly. You risk creating a whole new digital divide. And then there's the safety issue. We have to mention Operation Serengeti.
That sounds like a spy thriller.
Unfortunately, it was a real Interpol operation. They arrested over 1,000 people across Africa for crypto scams. The darker side of decentralization is that there is no customer support hotline if you get scammed. If you are your own bank, you are also your own security guard.
So it's still the Wild West. High risk, high reward.
Which is why the EY report really emphasizes ecosystems. They argue that these fintechs can't work in isolation. They need to partner with traditional banks, with telcos, with regulators to build safety nets.
And we are seeing some cool examples of that. I read about Millennium Capital, great name, by the way.
It is. They're partnering with development banks to help small businesses get funding, or a company called Credete, which helps immigrants build a credit score using their remittance data. They're mixing the old and the new to create something safer and more useful.
So let's wrap this up. What's the big takeaway? We started by saying this is beyond aid.
The big takeaway is that Africa is becoming a global test lab for the future of finance. We are seeing a shift from asking for help to building the tools yourself. The question isn't if crypto will be used in Africa. That ship has sailed. The question is how it gets integrated into the global economy.
And why should our listener, who might be in New York or London or Tokyo, care about stablecoins in Nigeria?
Because this isn't just about Africa, it's about the future of money everywhere. If stablecoins can successfully replace foreign aid mechanisms and swift rails in Africa, which is arguably the hardest environment to operate in, they can disrupt financial systems anywhere.
It's the ultimate stress test.
If it works there, it can work everywhere.
I want to leave everyone with a thought that really struck me from the Vanguard and scholarship pieces. If this technology allows developing nations to build their own financial rails that are faster, cheaper, and more efficient than the global standard we use in the West, what happens next?
That is the trillion-dollar question.
Will the traditional financial powers, the IMF, the big Western banks, will they adapt to this new sovereignty? Or will they try to regulate it out of existence to maintain the status quo?
History would suggest they'll try to fight it. But code is a very, very hard thing to fight.
And on that note, we'll leave you to ponder. Thanks for joining us on this deep dive.
A pleasure, as always.
We'll catch you on the next one.